The stock market is sending a very dangerous message right now. It is acting as though everything is fine. The S&P 500 just pushed to fresh highs. Again, Bitcoin is running hard. Dividend funds like SAG have been quietly performing well. If you only glance at the screen, you could easily tell yourself the panic from a month ago was overblown. The war risk passed. The market shook it off. And now the only real danger is missing the next leg higher. That is exactly the kind of environment that hurts people. Not because the market cannot keep rising for a while. It absolutely can. But because when prices move up cleanly in an unclear environment, people start confusing price action with safety. They see green candles and assume risk has disappeared. They see all-time highs and assume that means the market has already processed everything it needs to process. That is not how markets work. Sometimes the market climbs because the danger really has faded. Sometimes it climbs because hope, liquidity, and momentum are strong enough to overpower caution for a stretch. Those are not the same thing. And if you are close to retirement, already in retirement, or simply at a stage of life where a major drawdown would matter more to you than it did at 28, then you need to be especially careful right now. This is not the kind of market where I want people getting loose. This is the kind of market where discipline matters more than conviction. Let me tell you what is bothering me. There are two red flags that lit up this week. And they look uncomfortably familiar if you know anything about how bubbles behave before they break. The first red flag sits inside the AI mania. The second sits inside market structure and trading behavior. Now, I am not here to tell you AI is fake. That would be stupid. AI is real. It is important. It is going to change a lot of industries. But that does not mean every stock tied to AI is a good investment today. And it definitely does not mean every company that says the letters A and I out loud deserves your money. We have seen this movie before. Back in the 1990s. The internet was obviously going to matter. The people saying that were right. The people saying it would change the world were right. The problem was not that the technology was fake. The problem was that investors got ahead of reality. They started buying anything that looked like it might have some connection to the internet. Revenue stopped mattering. Profit stopped mattering. Business quality stopped mattering. Stocks went up because people saw them going up. And that was enough. That is how mania works. Eventually, companies with no real path to profit got crushed. The survivors survived. The fantasies did not. One of the most ridiculous features of the dot-com bubble was that companies with no real internet business simply added .com to their names and watched investors throw money at them. That sounds so absurd in hindsight that people assume we would never behave that way again. Then this week happened. A shoe company announced that it was pivoting toward artificial intelligence. That was enough to launch its market value from roughly $21 million to about $148 million in a single day. Nothing fundamental changed. No giant profit stream appeared. No deeply proven AI business materialized. No robust operating transformation had already occurred. The market simply saw a struggling company wrap itself in AI language and reacted like a gambler hearing music in the casino. That is not healthy. That is not sober price discovery. That is speculation wearing a technology costume. And if you think that is only happening in tiny names, look more broadly. Even the stronger AI-linked companies are trading at valuations that imply a very great deal has to go right for a long time. That does not mean they cannot still work. It means the margin for disappointment is thin. The internet was real in the 1990s. The bubble still burst. That is the lesson people keep forgetting. The second red flag this week came from market structure itself. Regulators signed off on the removal of the $25,000 minimum that used to limit certain kinds of retail day trading, replacing it with intraday risk-based margin rules. A lot of people heard that and thought freedom. I heard something else. I heard late cycle fuel. Because when the system removes a friction that used to stop undercapitalized retail traders from actively churning in volatile markets, the likely result is not some golden age of disciplined wealth creation. The likely result is more overtrading, more leverage, more gambling disguised as strategy, and more platforms profiting whether the customer wins or loses. That is the key part. The trading platforms get paid on activity. They do not need you to build wealth. They need you to keep clicking. So when market conditions are already emotional and speculative behavior is already rising, lowering the barriers to active retail speculation is not a comforting development. It is another sign that the market is getting hotter in the wrong way. The public sees opportunity. I see froth. Now put those two red flags together, AI naming mania, and easier pathways for smaller traders to churn in a euphoric market. That combination does not guarantee a crash next Tuesday. Nothing that clean ever exists. But it does rhyme with the kind of late-stage behavior you often see when people stop asking what they own and start focusing only on what is moving. And the market is not only dealing with internal froth, it is also still dealing with external risk that people are too eager to wave away. Take the Strait of Hormuz. Yes, right now it appears open. Yes, some of the panic pricing and oil backed off. Yes, the ceasefire language created relief. But relief is not the same thing as resolution. When you actually read the situation carefully, what you find is uncertainty layered on uncertainty. The waterway may be technically open, but military tension remains heavy. Regional friction remains. Conflicting reports remain, and even if no one fully closes the route again, the fact that markets now know it can become a problem at any time has already changed behavior that matters. Because markets do not only react to what has happened, they react to what could happen again. That is why I do not like how casually people are talking about the recent rebound. They are acting as though one positive week erased the underlying fragility. It did not. It merely reduced panic. And there is a large difference between less panic and real stability. Oil is still an issue. War-driven inflation has not vanished. The debt burden associated with a wider conflict has not vanished. The policy uncertainty has not vanished. The economy's dependence on those variables becoming calm has not vanished. It is all still there. Now add one more piece: earnings. For the rest of April, the market is moving into one of the most important windows it has faced in a while, because the next wave of earnings reports, especially from the biggest technology and AI-linked names, will do more than tell us what last quarter looked like. They will tell us whether this market is paying for a real earnings machine or for a story that distinction matters immensely. So far, the early earnings picture has looked decent enough. Consumer spending has not fallen off a cliff. That is helpful. But the late April reports matter more because they will speak directly to the part of the market carrying the most expectation. The Mag 7, the big AI names, the companies people are treating as if future growth is not just likely but pre-approved. That is where markets get hurt, when reality is merely good instead of perfect. A bubble does not need terrible results to wobble. It only needs results that fail to justify the fantasy. That is why I think caution matters so much here. And now, let me get to the part most people skip, which is what to actually do, because I do not want to simply tell people to be afraid. Fear is not a strategy. What matters is structure. The way I think about this market right now is not that the worst case scenario is just a normal correction. The real worst case scenario is that several problems begin feeding each other at once. The market starts dropping. Oil stays elevated or moves higher because the Middle East issue proves less stable than the headlines imply. That pushes goods inflation higher. Consumers feel pressure and start cutting spending. Companies then feel weaker demand at the same time as their own cost base rises. Margins compress, hiring slows, then layoffs begin. Now your problem is no longer just a falling portfolio. Your problem becomes a falling portfolio, a weaker job market, higher living costs, and less flexibility at the exact same time. That is the true danger. And if you are unprepared for that kind of sequence, you can get forced into exactly the wrong actions. You sell assets at lower prices because you need liquidity. You pay penalties and fees on debt you did not control early enough. You liquidate good investments at bad moments because your monthly life was too tight before the trouble even began. That is why I keep coming back to boring advice that people love to ignore when markets are hot. Have an emergency fund, pay off high-interest debt. Do not let your financial life become so fully optimized for upside that one rough stretch can throw you into survival mode. The reason people glaze over when they hear this is simple. It feels slow, it feels unexciting, it feels like something you will get around to later, but later is exactly when these things become painful. If you have 6 months of living expenses available, good. If you do not, then build toward 1 month, then 2, then more. If you have high-interest debt, eliminate it. Not because debt is always morally wrong, because expensive debt in a fragile macro environment is one of the fastest ways to turn a market problem into a life problem. Now, here is the important part. Preparing for the worst case does not mean becoming bearish on life. It means building a structure that works no matter which direction the market chooses next. If the market really does continue higher and the worst scenario never materializes, wonderful. Then you are sitting with extra cash discipline, cleaner balance sheet habits, and more investable income, because your debts are under control. That is not a bad outcome. That is a very good one. And if things do get worse, then you have breathing room when others do not. That is how the rich get richer in difficult cycles while the fragile get forced into bad decisions. Not because the rich are always smarter, because they are less exposed to being forced. Now let me tell you how I would actually invest through this kind of environment. I am not chasing the flashy thing. I am not buying a random AI name because it doubled this week. I am not pretending I know exactly what the market will do next month. I am doing something much more boring and, in my opinion, much more powerful. I am dollar cost averaging into the same broad market ETFs that have worked through wars, recessions, inflation scares, policy confusion, and a century of human panic. The S&P 500 remains central. That is not because it is perfect. It is because broad ownership of productive enterprise still works over long stretches of time better than most people as attempts to outsmart it. And one of the most important facts people forget when they get scared at highs is that the S&P 500 hits all-time highs all the time. That is what a long-term rising market does. It reaches new highs, then later reaches higher highs. So for me, the presence of an all-time high is not a signal to abandon the process. It is just part of the process. That is why I keep buying broad ETFs rain or shine, not because I am unaware of risk, because I do not want my investing life to depend on my ability to correctly predict every macro twist before it happens. Now, that does not mean I ignore caution. It means caution belongs in the structure, not in emotional market timing. My caution lives in emergency reserves, in debt discipline, in refusing to speculate heavily in overhyped names in position sizing, in the willingness to let broad, durable exposure do the heavy lifting instead of trying to get rich on one story. That is the difference. Gamblers try to make one great decision. Disciplined investors try to survive many imperfect environments. This is one of those imperfect environments. The market is strong, speculation is visible, the macro backdrop is not resolved, the policy path is still messy, the earnings bar is high. That is not a reason to panic. It is a reason to stay sober. So if I had to reduce all of this to one simple instruction, it would be this. Do not get fooled by strength. A rising market can still be fragile. A hot theme can still be dangerous. A rebound can still be built on hope that has not yet been tested. And if you are close to retirement or managing money that cannot easily be replaced, the right response is not fear. It is discipline. Protect your downside. Own broad quality. Avoid the manic corners. Keep liquidity. Eliminate weak spots in your financial life. And let the market prove more before you start acting like all risk has disappeared. That is how I would approach a market like this. That is how I am approaching a market like this. Because when the froth is this visible, the most important thing is not being the boldest person in the room. It is making sure you are still standing when the room finally remembers risk exists.